Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice.
Yeah.
Hey folks, on the line I have Joshua Scigala. In addition to being an award-winning designer and animator, he is founder and CEO at Vault Toro. Now, Vault Toro is a physical gold to Bitcoin exchange. He's also co-founder at the Standard.io. Now, that is a stablecoin protocol. And on this show, we know how important stablecoins are, as well as how much damage they can do if they are mismanaged. So, Josh, if you don't mind, help me understand how the Standard is different. What sets you apart?
Yeah, well, really, I come from the old school. I found Bitcoin. I've been working in Bitcoin since 2010, and really there was not many people in the industry back then, and it was all about not your keys, not your crypto. And that philosophy is sort of being gone over time, but also the philosophy of rare assets is very, very important. So when in 2019 I flew over to Uruguay to give a talk at the largest South American Bitcoin conference about stablecoins, and on the way there I read the white paper for Terra Luna, and I came off that plane absolutely white, like this is going to collide. It's a bit of an exaggeration, but I realized this is just another one that's going to fail. And it wasn't that I'm a genius or anything like that. It was literally that I've seen these before. There's been plenty of experiments in crypto where algorithmic stablecoins have tried the exact same thing as Terra Luna and failed. And it's just that Terra Luna managed to grow really, really big and then fail. And and we actually said that on stage, on camera in 2019, one of these is going to rise so big and it's going to be a massive calamity when it fails. And then the state will come in with their superhero costumes on and regulate the heck out of everything. So
yes, exactly.
And that's the biggest danger.
Yeah, I absolutely agree. And we saw a lot of damage that came out of the Terra Luna, and the people you called it out in 2019.
Yeah.
And people ignored it for years. And then we saw a calamity happen. And I think that's a big part of what's going on today. What do you think?
Absolutely. We're still seeing the fallout. I mean, some would say that even the FTX fallout is because of, obviously FTX was an absolute sham and a scam and are running an absolute fractional reserve and trying to buy out political, protection and all sorts of stuff. But apart from that, one of the pegs in that whole big, one of the dominoes in that row is Terra Luna collapsing. So, yeah, what we've really focused on at the Standard is to go back to solid principles, and it's called the Standard from the gold standard. It's called the Standard because we want to become the standard in stablecoins that's fully transparent, but fully over collateralized as well. And so we can talk about the grand vision of the thing, and then we can go back to how we're launching on Monday the first stablecoin, because actually we're a suite of stablecoins. As most people know, there's just mainly USD stablecoins right now, but there's the European zone is actually just as big as an economy as a whole, and also we have a lot of freelancers working online in the crypto space, but even just not in the crypto space, but just online, and they want to get paid in stablecoins because it's instant settlement, but they want to invoice in their local currency, and it just makes it easier for accounting, right? So our focus is really to have as a grand vision to allow a system where you can provably have no trust in a third central party. So we can't have something like FTX or Celsius or BlockFi. We trust the code. We trust DeFi, and you have your keys. You don't give your crypto to anybody, but what you do is you actually send your crypto. Let's say you've got a whole bunch of ETH and you're long ETH and you're thinking, I don't want to sell it, but I need to buy a new car. what you can do is you can put, let's say, 10,000. I'm just going to stick with dollars for now because it's easier. But the first stablecoin we're launching with is euros, but then we'll release SUSD and Indian rupee and Australian dollar, British pound, and the rest of them. But just to make it easier, we'll stick with USD for now. So what people would do is they would lock up $10,000 worth of Ethereum into a smart contract. Now that smart contract is owned by the people opening that up. They have the only key for it, so no one can speculate with those. And what they do then is lock it. Now that 10,000 worth of Ethereum is locked into that smart contract. Now they can unlock again, but why you want to lock it is now you can mint brand new stable coins up to 85% of that value as SUSD, for instance. Now that you've got the SUSD, you can go and sell that and buy your car, with that, or sell it to actual USD and then buy a car with that. And the great thing is, this is kind of a debt to yourself. It's a loan to yourself. And the good thing, there's no capital gains tax because you haven't sold your crypto. You've just borrowed against it. And B, because it's a 0% interest loan that has no time limit to pay back, inflation is effectively paying off your debt.
Oh, that's very good.
Yeah,
I see that.
Yeah. So, and if you look on a whole scale where there's thousands of loans out, everyone can tell that there's more value, real value, rare numbers, not numbers that we can print out of thin air like Terra Luna could have, but real assets like Ethereum, Bitcoin, and tokenized gold locked up in these smart contracts. And they can see exactly how much is locked up and how much is floating around. And there's always less floating around than there is collateral locked in the system. So effectively, it's like a private gold standard that, I always say we don't need as old, I'm an old school gold bug. We don't need to beg the state for a gold standard. We can now, we're creating a system where people can create their own gold standard because it's effectively backed by a rare number. If you look at the gold standard, what was that? It was where the government held a bunch of gold on reserve, and they issued paper certificates or credits on that gold, which was redeemable in gold at any time. And effectively, this is the same thing, except we're adding rare numbers in there. We're adding digital gold as well as physical in terms of tokenized gold.
So does that, my question is, we know it's really challenging to keep a stable coin on a fiat peg. We've seen a number of times, even widely used stable coins like Tether have lost their peg. How is that different from like a physical asset backed stable coin? Is it as volatile?
So that's a really good question. How do you peg something? And while Tether, you can say that it lost its peg, it really, in the big scheme of things, it hasn't. It's gone down a little bit and it went straight back up, or it's lost maybe a cent or something like that. Now, if you've got, millions and millions of dollars, obviously that cent makes a difference, but it wasn't for very long. The reason why these centralized stablecoins are dangerous is because we've gone from Bitcoin, which was this decentralized system of money that could compete. It was an exit door against governments that mistreated their monetary policy. So, I'm not talking about the US government here or any government. I'm just talking about there are governments that either they're really good now and then they turn bad or whatever, but sometimes they just mismanage the funds. And so Bitcoin was an exit. Now, if you have a centralized stablecoin, we can have another calamity like FTX, because these stablecoins are basically, for those that don't know, a centralized stablecoin is a stablecoin where a company puts $1 in the bank and issues one ERC20 token, like a one crypto token for that, and says, whenever you come to me with that, we'll give you $1. And the problem with that is, banks are legally in fractional reserve. So the banking system is speculating with those underlying funds. We don't know where, totally intransparently. And if we have another 2008 financial crisis, it could even go altogether. And then we have the other side, which is the crypto side, actually also speculating with those funds. Yes. So both sides are speculating. It's a terrible thing. But also, if the state was to come in and say, right, that's illegal now, we're making it illegal because CBDCs are coming in and we just want to shut it down, that would really hurt the entire crypto industry as a fledgling industry. And it's a kind of an attack vector, some would say. So the idea is to create a stablecoin protocol that is decentralized in its issuance, in its issuance, but also decentralized. It's also ultimately transparent and fully and overly provably over collateralized. So this is a value proposition that's way better than the banks. Now, if we look at how to peg that, well, what is a stablecoin? A stablecoin is a system where you say you've got one SUSD and you want to, which stands for standard USD, and you want to buy one USD worth of anything else with that. That's what pegs it. If I can go and buy $1 worth of ETH with that, or $1 worth of tokenized gold, or anything else, then that's $1. So what we're doing is we're launching every new stablecoin we launch on the protocol, which is based on Ethereum, which on Ethereum right now, but we might be moving it across to Polygon. And by the way, guys, if you have anything to say about that, you can join the Discord and have the conversation there. But what we're doing is we're launching with a stability pool, a large pool of assets that will always trade back for it'll be like a 100 basis point spread or something like that. So but let's just, to make it easy, it'll always sell back at, like, give you $1 worth of value for your SUSD. But how we build that pool is we're doing it with Euro first. So I'll jump across to the Euro example. Effectively, the same value right now, so it's just another word. But what we're doing is we're selling the first S Euro at a discount at 80 cents through this smart contract. So people will send in some Ethereum, and they'll get €1 at the price of 80 cents. And as more and more liquidity comes into this pool, that discount becomes less and less and less until we reach a 1-to-1, until that discount is totally gone. And then at that stage, people can obviously, anyone that's done their maths, this is slightly under collateralized now, because it's the first launching event. But while people are, and we're not considered a stablecoin until we reach that 1-to-1 on that discount. But while people are waiting, and they feel that you've got an instant 20% yield on that, but you feel like, hey, what can I do now while I'm waiting for it to reach 1-to-1? What you can do is you can take that S Euro and a USDC and make the first trading pair on Uniswap, and we'll buy that liquidity off of you for a bond, and you can choose different times for the bond, like 7 days, 30 days, 90 days, all the way up to 365. And the longer the bond maturity is, the higher the yield. But we'll buy that liquidity off you for that bond, and that bond will pay back in the membership token, the TST. And we can go into the value proposition of TST, which stands for the standard token, which is the membership and governance token of the whole system. But it's a lot of people are really excited about this mechanism because it helps the protocol gain value and gain this stability pool. But on the other side, it pays out a really nice yield for people, and people know where that yield's coming from. It's not like, and this is a really important thing in DeFi, and this is what's lovely about these bear markets as well. The bear markets make people ask real questions. In the bull market, nobody asks any questions. It's terrible, and that's why you have these calamities. But in these bear
just how much can
markets,
this make me?
What's that?
Yeah, they're just asking how much money can this make me. Nobody's asking the fundamentals.
Yeah, like where's this reward? Where's the APY coming from? Terra Luna, they were just printing it out of nowhere.
No one asked that question, and that's why we are where we are. Yeah,
and that's why podcasts like these are so important, to really educate the people to ask the right questions when it comes to these sorts of projects. I mean, these are even what we're building is an experiment in economic theory. Although I've based everything, and the protocols based everything on sound economic theory from over 5,000 years of gold, but also the gold standard and understanding economic. For instance, we've got the grandson of Milton Friedman on the team,
Wow.
Patry Friedman, and his father, David D. Friedman, an absolutely stunning economist, wrote some of the most important papers and books on the subject of freedom when it comes to economics and economic theory, and also with his grandfather. So we have a really stellar team, and really focused on, and we didn't get that sort of stellar team from having some weird economic theory that doesn't make sense.
Yes. Yeah, that makes sense. Do you think you've mentioned FTX a couple of times, and I know one of the things that you invented was the glass books protocol. Do you think that would have made a difference at FTX?
Absolutely. It would have absolutely made a difference, because what happened was, like I said, I've been in Bitcoin for a very, very long time.
Since Satoshi Nakamoto walked the earth.
Yeah, he was still in the forums when I was there, and but we were all using this Bitcoin exchange, the first one called Mt. Gox, MT Gox, which actually came from a Magic the Gathering online exchange platform that converted to a Bitcoin forum exchange. And we had this big calamity happen, and everyone lost their Bitcoin. And after that, this wasn't the first back then. There was a string of these hacks, so-called hacks, and things. So for us, it was like, I sat down with my brother and thought, right, how do we build a system, a decentralized exchange? First, that was the first idea. And Ethereum hadn't been built yet, hadn't been invented yet. And so the programming language behind Bitcoin didn't allow for that, really. So we focused on the transparency of the blockchain instead. And we built a protocol where any exchange could prove in a grandma-friendly way how much Bitcoin they've got and how much money their creditors have on the exchange. And it was provable through the blockchain. And no one would take it. None of the exchanges, we shipped it around, no one was interested. And that goes to show that a lot of these exchanges are in fractional reserve, and that's why then they weren't interested. So we sat down and thought, all right, let's create an exchange and implement this. And so we created Vaultoro.com, which is Vault as in a gold vault, VAULT, and then Oro, ORO.com. And that was the first Bitcoin physical gold exchange that traded in an order book between allocated physical bullion sitting in a high security vaulting facility, audited by BDO and insured by Lloyd's in Switzerland. And people could see exactly how many Bitcoin is in there and how much gold is in there. So it didn't only work with Bitcoin. The problem though is with these proof of reserves is that you don't see the liabilities.
Right. Yeah, because it's stored off chain and then it's reported on chain, but it's not directly reported. It's just somebody said so.
Well, yeah. I mean, if for instance, what Sam Bankman-Fried was doing, he had all of this. So let's say he was in full reserve and proving it. Let's say everyone could see in real time how much Bitcoin they've got in their cold wallets and how much Bitcoin the sum of everybody is holding on there. Then you don't know if Sam's gone off and made a written human contract with someone to use that collateral as some sort of deposit on a large loan. Right. And that's exactly what he did, except he was hiding it through multiple moves and things, which was ridiculous. But you don't know. It's very, very hard to prove a liability on that. And that's why decentralized finance is so fantastic, because all the liabilities are in code. You can see if there's a loan against something, or if something's, if there's some sort of instrument on the actual crypto, it's in the smart contract. And so you can run some software and actually see everything. So there's no sort of human contracts being written in behind closed doors with other people's money. It's really, really transparent, and it's very, very secure, because code is the law. Code is the code is what actually is the rule set, rather than human fallible laws.
So I would do want to ask an important question. What gives you the most hope when it comes to stablecoins versus CDBCs? Because I'm pretty firmly on team stablecoin. What gives you the hope to keep fighting that fight?
Yeah. What gives me the hope is that CBDCs, first of all, for those that don't know out there, are a complete infringement nightmare. All the blood that's been spilt in wars over centuries has been for naught if we allow CBDCs to come in, because they are an absolute mammoth of control grid over your life. I don't know how much clearer I can say that, and I'm someone that's really been in this industry a long time.
Yeah, I don't know that you can overstate it.
Yeah, it's really horrific, and maybe I can come on the show sometime and just back and we can just specifically talk about why that is, what makes CBDCs, because effectively people think, oh well, it's a digital currency. I'm already digital. I use digital money with my bank and my credit card, so they don't know the difference, and we can talk about that some other time because I know we don't have that much time. But
Sounds like a good show. We should do that.
yeah, let's do that for sure. But effectively, what gives me hope is that these smart contracts, all we're doing is writing a whole bunch of contracts that create a system that can run autonomously. And while these CBDCs are so horrific and everything, the only thing that will keep a check and a balance on these is if there's an exit door. If there's an exit door, if there's a CBDC so horrific where all of a sudden the government says, right, there's an obesity epidemic, and we no one's allowed to buy more than 4 chocolate bars a month. Mm-hmm. And your wallet will just abide by that. Like, beep, no, it's a chocolate bar. Your money doesn't work. Or, the economy's on the down. We need to stimulate spending. Now there's an expiry date on your savings, so you have to move your money. You have to spend your money, otherwise it'll expire in value. So if they were to do something like that, there's an exit door called DeFi that people can go, well, you guys are screwing with my money. I'm off. I'm over here. And well, pardon me. That's what really gives me the hope, is that that with this exit door, it gives people the option, and CBDCs now have to compete in terms of friction. If they put too much friction onto CBDCs, onto people's lives, then they will just exit, and that's really what gives me hope.
Awesome. All right. Well, sir, I know that you are launching on Monday. Tell me, how can folks get involved?
Yeah, so on Monday is the first stablecoin issued on the standard protocol. This will be on the Ethereum chain. And yeah, like I said, the people can get a very fast, instant 20% under €1. They buy the first stablecoins at a discount. Now, as more and more volume comes in, as more and more people come in, so you have to be quick. That discount becomes less and less over time until we reach that 1-to-1 peg. But during that time, there's that, and have some USDC ready as well, because once you've got that SUR and you're waiting for it to get to that 1-to-1 peg, you can actually lock it up. You can put it into a liquidity pool on Uniswap, and it's all through our interface. It's very easy. It's just a bunch of clicks, and you'll receive a really nice APY. So all up, that's like 65% APY or something like that. So it's a very strong incentive, and for that, you're helping a really great team, a really great project to deliver something that I feel personally will help towards making sure that we keep our freedoms from and have that exit door. And then when you receive that APY in that second stage for bonding the liquidity on Uniswap, you'll get rewarded in the membership token, TST, which is the standard token. And this basically grabs it. Once you stake this on the system, there's a nice yield on top of that as well, and that yield comes from eventually will come from once the smart vaults get released, the private smart vaults where users lock up funds and mint themselves new stable coins. When that comes, there's fees. So it's a 0% loan in terms of interest, but there's a fee, like there's an opening fee and there's a closing fee and there's a yearly fee on having that the system just has. It's hard coded in the system, and those fees get dropped down and they will get distributed amongst TST stakers. Now the thing is, it's not a security because people have to actually work for it. They have to do something with their TST. They need to come and do some things and actually work. So it's almost a reward for doing some stuff. It's not, you can't just hold it and expect to be, airdropped money.
Sure.
So
that makes sense.
Yeah. So, I'm super excited that also, if you guys, if any of your listeners, you're not into participating, or you're not into like nice, strong yields because you're just sort of looking at the market and understanding it, you can also just come and stop by the Discord server or the Telegram and help out. If you're a graphic designer, if you're an editor, if you're a podcaster, if you're if you've got some just interest in economic theory and you want to discuss certain things, we're there, so you can join and have fun discussing with really a whole bunch of great minds.
Josh, I want to thank you so much for your time. I've learned a lot and I had a great time, and you are welcome back anytime you would like. You just let me know.
Thank you very much, Nick. It's been an absolute pleasure.
Thank you, sir.
Cheers.
And in addition to thanking Josh, I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.